You may think you know all about life insurance and how it works, but do you know how a withdrawal or a policy loan affects your coverage?
You are listening to Wealth Talks, where we talk about solutions for your prosperity with Dr. Tom and John McPhee. Policy loans and withdrawals, you've heard of them. Maybe you've heard that they're a good thing. Maybe you've heard that they're a bad thing. Today, we're here to break it down, and you'll get to hear what are the conditions where you might want to consider a withdrawal or a policy loan, and how and when do these make sense for you?
Well, first of all, you need to understand that a policy withdrawal affects the value of your policy because you're taking away something from it. So if you have a permanent life insurance policy that has developed cash value, in a universal life policy, when you take a withdrawal, you're simply withdrawing money that is accumulated in your cash value. That can come from an overpayment of premiums that you've put in there, or it can be coming from the interest that you've earned in your life insurance contract.
Okay, so the withdrawal is coming from the accumulated values when you're talking about a universal life insurance policy. That's a type of permanent insurance.
It doesn't affect your death benefit, but it could in the long run because universal life policies have flexible premiums.
Sure.
Which means that you don't have to come with the premium out of pocket if you have enough money in the accumulated cash value to offset the premium without you coming up with it yourself.
Sure. So those accumulated cash values are buying the insurance every single year that's your death benefit.
That's correct.
So you're basically saying you can take a withdrawal on a universal life policy without lowering your death benefit right now. But then if that cost of insurance is there in the future, you're going to have to pay for that cost of insurance or drop your coverage.
That's right.
Okay.
And with a universal life policy, unless you're paying extra for a rider to have your death benefit go up, your death benefit is level anyway throughout the contract. So when you withdraw from a universal policy, you're really just withdrawing your own money.
Mm-hmm. Yeah, money you paid in there.
In a participating whole life insurance policy, which is also a type of permanent insurance, which we favor here at Life Benefits, Wealth Talks, when you take a withdrawal, you actually surrender part of your death benefit because in whole life insurance, it's the only life insurance that you build equity in. So it'd be like surrendering part of your house instead of getting a HELOC or a home equity line of credit. You'd cut off your garage and sell it. Well, in life insurance, you can actually surrender part of the death benefit because as time goes on, you become owner of that death benefit and you have a certain amount of equity in it at any given time.
So it'd be like downsizing your house if we're thinking in terms of homes.
Correct.
Okay.
Yeah.
So you could downsize, and when might you want to downsize?
Well,
policy?
If you don't need the coverage, you could, downsize by withdrawing the cash value out of it. Or maybe in retirement when there's no real beneficiaries left that need the death benefit, and you're just trying to have a better standard of living because you've saved money and built cash value in a life insurance policy, and you plan to use this for your retirement.
Okay. Now, are withdrawals taxable?
Withdrawals can create a taxable event in your life because when you withdraw money from a life insurance policy, you can withdraw it up to what the cost basis or the money that you have paid in premiums to the life insurance company. So let's say that I've paid in, $50,000 into my life insurance policy, and now I want to take a policy withdrawal. I can take $50,000 out of that policy without incurring a tax liability. But as soon
that's
as
money you put in.
That's correct. But as soon as I take out $50,000 and one penny, then I'm over the limit. And now
So you would pay tax on the penny.
The IRS is going to say, oh, this is earned income, and I'm going to pay income tax on it.
Okay, so what if you don't take a withdrawal past what you have, past the money that you paid in?
Then there would be no taxes.
No taxes. So that could be a great tax strategy for part of your retirement income if you want to minimize your taxes.
It's a huge tax strategy, and it's being used very frequently by wealthy people as a way to protect the assets that they've built and be able to withdraw this money and still have a death benefit to pass on to the people that they wanted to give an inheritance to.
Okay. So some people will say, well, you shouldn't take a withdrawal. You should take a policy loan instead. When would you want to take a policy loan rather than taking a withdrawal?
Well, a policy loan is very helpful for you if you want to recover the cost of financing in your life, or if you want to have opportunities for investment, or if you have just need of an increased flow of cash flow for short periods of time. Again, when you take a withdrawal, you're reducing the policy's value, either the accumulated cash value or the death benefit, depending on what kind of permanent life insurance you have.
And that probably decreases the growth then too.
It can.
Yeah.
Yes, because depending on what kind of loan that it is, and universal life policies have multiple different types of loans, whereas in a whole life policy, if you withdraw, you're reducing the equity you have in the policy, which is what your dividend is based on. So you're killing your growth there as well.
Sure.
But, if you want to take a policy loan, a loan is not considered a withdrawal unless it's not paid back.
So take the example that you were talking about earlier. You've paid $50,000 for your policy. You could take a withdrawal for $50,000, but if let's say the value of the policy is built up, you could access $80,000. You can't take a withdrawal for that other $30,000 without paying tax on it.
That's correct.
But with a policy loan, you could take all $80,000, right?
With a policy loan, you could take probably about 95% of that $80,000.
And no tax.
And in a whole life insurance policy, that's not going to affect the guaranteed growth of it, because when you take a loan, you use your equity or your cash value, paid up insurance, as the collateral, and the insurance company lends you their money. Now, in a universal life policy, there's different loans. You can actually borrow your own accumulated cash value. Then you're required to pay it back with an interest rate that the insurance company sets, and if you don't, then it's considered a withdrawal.
Sure.
Or you could say, I'm going to put my cash values up as collateral. I want to borrow the insurance company's money, and then your cash value will continue to accumulate like it was, and the interest you pay goes to the insurance company.
Okay.
Again, if you don't pay it back, it's considered a withdrawal. In a whole life policy, there's never a requirement to pay the loan back as long as you pay the interest. And so this gives you the opportunity to use someone else's capital, pay a nominal amount of interest for it, and if you can make more with that money than the interest that the insurance company is charging you, you get unlimited use of someone else's money while your money continues to grow in the policy.
Continues to grow. And if it's that loan, then no taxes as you use that money, which is pretty cool, because anytime you access, maybe you could access money in your 401k, but then you have to pay it back within 5 years, and you can only take it for certain things. Whereas this, you get that use of that money tax free. You just have to pay the interest on it, and that is important. So, what would happen if somebody doesn't pay the interest on a policy loan they take?
Then that interest is compounded into the loan balance.
So it starts increasing. So you take 80,000 this year, it might be 85 or 90 next year. It just keeps growing up like that.
And what can happen is if that loan balance gets larger than the equity in a whole life policy, then that could be considered a withdrawal, because we can't face that, and now you're going to be forced into a withdrawal situation.
So that would be the downside. You never want to let loan get to that point.
That's correct.
Okay. So with that in mind, when should you consider taking a policy loan? When should you not consider taking a policy loan? Are there certain things that you want to be thinking about as you do this?
There are. When you can make more money with the money you're borrowing against your policy than what you will have to pay in interest for the policy loan, that's always a good time to take a policy loan. Okay.
Unless, I'm going to play devil's advocate here. Unless there's risk that goes with it. You were talking here on the Wealth Cruise just a few weeks ago. If you had a 10% chance of doubling my money, would I do that? Does that make sense to do?
Well, it really doesn't, because you take doubling your money. Let's just work with $10,000. You've got to take $20,000, which is double your money. You got to times that by 10%. That means that the most you could make out of this investment, really, your risk is the probability of you doubling your money is about 2,000. It's not worth it.
Yeah. Okay.
So until that probability gets up there significantly higher, probably over 50% for most people, then you've got to consider, is this a good risk to take or isn't it?
Okay.
Now, with risk involved, if you take a policy loan and you don't make a good investment and you end up losing the money, you still have not lost the growth on it as long as you continue to pay the interest.
So that's
really
a
positive.
News. That is really good.
So
news.
it lowers the risk, increases your probability that you might make something on this even. So that's another reason to be considering policy loans instead of, for example, borrowing money from a third party to make an investment, or even using your own cash.
Sure, because you won't get that high return day in, day out in whatever you're investing.
That's correct.
All right, so you're basically saying, it's a great idea to borrow when you know you can make a higher return outside the policy. Just don't want to take on too much risk to do that. That makes total sense.
And that's just with any investment. You want to be looking at the probability of how valuable this is compared to what it's going to cost you.
Okay.
Well, another time that you want to consider a policy loan is if you're going to transfer debt. And what we mean by that is if you have, let's say, an 8% loan someplace, and you know you can get money out of your policy against your policy at a loan of 5%, well, then that's a 3% savings right there.
There you go.
That's a no-brainer.
Yeah, you were going to discipline yourself to pay back the bank or the credit union, whoever you borrowed that money from, so might as well pay back a policy loan.
But what about when the policy loan is actually higher than what you're paying for someone else? Can you ever make money doing that?
Yes.
And the answer is yes, surprisingly. But the policy has to be more mature.
Yes.
So let's take a policy.
It always has to be a long-term case in this with short-term financing need a long-term horizon where you're thinking about the policy growth.
So, for example, let's take a policy that's paying, about $9,000 a year for 4 years. And now when you pay the $9,000 in year 5, you've got a cash value increase that is, 16% higher than the annual premium you just paid.
So that's a good deal.
That's a good deal.
Yeah.
We got to figure that math into this loan transfer and see if it's this debt transfer to see if it's going to make sense. Or what about when a policy gets out 15 or 20 years and the policy is now paid up and there's no more premiums required and the policy is still growing by $10 or $12 or $15,000 a year because of the premiums that have already been paid.
Yeah, so now you're putting in nothing and experiencing growth on that. That's a pretty good. Well, you can't really calculate that without any outlay, just as an annual year-over-year return.
It is, and that's like a business. Like you've put a lot of money into it, and then it's just creating a passive income for you for the rest of your life. And that's what life insurance does, particularly participating whole life insurance. That's why we really encourage you to be considering this, because when it gets to that point, you can transfer all kinds of debt that you normally would, and you'll be making that up because of the policy growth.
Okay. So how would it work borrowing at a higher rate of interest for the policy loan and paying off a debt at a lower rate?
Well, let's just look at an example. Let's say that your policy is at a point where it's actually producing about 2.75% annually.
So that would be like the internal rate of return, taking into account all the premiums
that have been paid up to that point.
Okay.
which
it
isn't a
includes
huge
time
amount of
factor.
rate. It's not a really high internal rate of return, but it is a return. It's a
Right.
positive return. And so if you look at that for 5 years, that means that on a $10,000 loan, on a $10,000 cash value, that means you'd have another $1,452
There we go.
in 5 years.
Okay.
So now, what if you're paying a loan down with someone else that it's at 3%? Obviously, now the 3% is less than the 5% that the insurance company is going to charge us for a
Correct.
loan. That's a 2% difference. Normally, we'd say, oh, we need to really be careful here because we don't want to pay more interest by transferring this loan.
And you will pay a little bit more if you took the policy loan.
You will. Yeah, absolutely, because it's at 5% instead of 3%. But we've got to take into the fact the internal rate of return in this policy at this point. And it's 2.75%. So when we get all said and done, yeah, we can borrow the money from the policy, pay the third party off and no longer pay the 3% to them, pay the 5% that the insurance company needs back to them, and we end up only paying $96.01 for this loan instead of $781 if we would have kept the 3% loan.
So you can still make money on this because you pay a lot less interest net there. And then you also have the continuing growth in your policy continuing on. So let's take this a little bit further now and say, well, let's say that you're not in a rush to pay off that 3% debt. You can just go ahead and pay it off at your own pace and let the policy continue growing at the same time. Maybe this isn't a debt that has to be paid off right away. If it does, go ahead and do it. You can see that your interest costs will be lower. But what if you could just go ahead and not rush it, keep both of them? Wouldn't that put you further ahead?
It certainly could, especially if that 3% is on a mortgage.
Sure.
Where you're getting to deduct some interest or an investment risk that you've taken where you get to actually deduct some of that. Now you've got to take that into consideration too.
Yeah. So it's not always best to pay these off. You have to always think of both. Can you have both? Can you have the growth in the policy, that $1,452, and only pay $781 of interest? That would put you even further ahead if cash flow can work out that way. And that's why it comes down to cash flow in the end. What responsibilities do you have? Do you have to pay that debt off right away, or can you let it ride for some time? With a mortgage, that's definitely something you can let ride for 30 years in many cases.
And, as we alluded to earlier, you want to be able to have high cash values in your life insurance when you come into retirement, regardless if you have high 401k or IRA savings or not, because markets affect 401k and IRA balances.
They do.
And you don't want to be spending down your principal when you're on a fixed income in retirement. And the life insurance then would give you an opportunity either to withdraw money like we hinted at earlier, or actually to take policy loans to offset the downturns in a market.
Okay. And something else I'm going to bring up here too, this is a little bit more of an advanced strategy, is sometimes the policy, the death benefit can become an important planning tool here, because you might not want to draw down principal to that you want to leave to your heirs, your kids, your grandkids. But if you can draw down principal and know that they'll still get the money through your death benefit, then that allows you to guarantee an income in a different way, sometimes using an annuity, that you can guarantee a higher income than if you didn't have the life insurance policy. And that's an important part of the death benefit as a planning tool that many advisors ignore.
And really what you're doing there is you're deciding before you die whether you want to pay the IRS a bunch of money or whether you want to give that money to your children or a charity or a foundation or your alumni association. It's a choice that you can make before you die if you look at this annuity life insurance strategy that the wealthy and high-income earners use very frequently to preserve their wealth.
Right, and that's a good point, because someone just living off income from a 401k or IRA, in most cases, is going to pay a lot more in taxes than if they have money that is tax-free as well. It's
Yes.
If you have tax-free money, now that opens a whole new strategy that you can actually decide what years you're taking the taxable money, what years you're taking, and how you're mixing that together to pay the lowest taxes possible.
And you may not understand this, but we certainly do, that when you have a high balance in your IRA or 401k, like everyone is pushing people to obtain before they retire, now when you take the required minimal distributions from those, you are put into a tax bracket that forces you to pay up to 50% or 85% tax on your Social Security benefits, which not only that, the required minimal distributions that you're forced to take are at such a high percentage level that they will force most people to run out of money before they die, according to the actuarial tables.
Yeah, you are pulling principal when you take those required minimum distributions. So unless you have a plan for what you're doing with the principal beyond just the interest that you're living on, then you absolutely could be risking running out of money.
And that's another reason why you would want to have high cash values and permanent life insurance at those times, so that you can access that money without affecting your tax rate and without being forced to be in a different tax bracket than you want to be and pay more taxes than you want to in retirement.
Yeah, it's saving money in taxes. You're going to have more money at the end of the day. That's always a good thing. Nobody likes paying Uncle Sam more than we have to. So you are listening to Wealth Talks. We talk about solutions for your prosperity. Any of these strategies can be helpful for you or somebody that you know. Give us a call, 702-660-7000. We'll be able to guide you, make this whole process easy for you, so you can keep more of the money that you make, both now and in your golden years. You're listening to Wealth Talks. We'll be back next week.